going to wait 1 more minute for more people to join the webinar. I hope everyone can listen me okay. Here, what I am showing is the Skyblue platform homepage, and we are going to start right now with the topics that we are going to talk today and about the results of the tech companies. That it has been a really interesting week for some of them and a very sad week for other of them. So to begin with, I'm Sebastián Musso, CEO founder of Skyblue Analytics. Skyblue Analytics is a software company that basically has created a platform for B2C traders, retail traders, and also family office that want to get that analytics that in a different way that it wouldn't be possible for them as this current tool doesn't exist in the market. So the market is going to close in 57 minutes approximately. Yeah, 56, 57 minutes. And well, we are going to start about talking what happened with the tech companies. So basically, as you can see here, there are some tech companies like Apple, Amazon, Google that today had a really good return compared to last day. Actually, Google did really bad. Microsoft would say that in the middle of the table, but the only one who outperformed forecasts in terms of earning per share was Apple. Amazon today, it went up to 20% down, 20 points. If we can search it here, Amazon, it reached less than 100 for today. We can watch it here, that information in the fundamental data area that basically provides the trader with a summary of all the fundamental information of the company. It reached a daily range. It reached today 97.67, so below $100, and 52 weeks high, 188. 1 year change, minus 40%. To be honest, amazing how Amazon has gone down and how its market capitalization that almost reached 1.7 trillion. As you can see, also some options information. The IB high reached 60.27, which was reached basically this in the last 13 weeks. Let's analyze a little more about this tech company that I really like it, but has done really bad in the last 12 weeks. Well, here you can see the value, and if we take a look to the IB ranking, this is going to be the 100% value. This makes sense. Why this makes sense? Basically, the IB ranking, one takes into consideration is the lowest and the highest value in a period of time. If we see it in 52 weeks, you're going to see that the lowest value was reached on the 3rd of November and the highest value was reached on the 27th of October. Basically, it gives you the absolute value of the highest point, lowest point, and each point of IB in this series. Why it makes sense of what happened the other day? Well, because the results of Amazon was below expectations. Amazon didn't reach the expectation of earning per share and of sales. So yes, that's one of the reasons that is one of the company with highest market capitalization in the US. If I am not wrong, the third one now is losing 7.7%. On the other hand, if we focus ourselves a little more for Apple, well, Apple is still quite far from the 175, 174 that reached on August 18. The IB has considerably going down, and today was an amazing day, increasing like well, you can see here 7.74%. with an upcoming earnings, with earnings which were an earning per share was 1.29 compared to the forecast of 1.26. So really good results. Here we can also see the, I'm going to return to this. So from the highest market capitalization, mega cap above 198 billions for next week, for today and for next week when the market close, we have basically the oil companies, ABB, and then we are going to have more consumer defensive companies like Pfizer and British Hathaway. Yes, here I have a question. No, the platform that we are using is, I'm going to write it here, analytics.com is a platform that, again, I am the CEO of this company, and it's a new platform to analyze stocks and option strategies. Now we are going to do some option strategies live, so you can learn how to do these strategies and how to perform these strategies. But still, in the last months, we can see, if we make this bigger, we can see that still the oil companies are the ones who have outperformed, like ExxonMobil, that has been 70% up. All the numbers, the gross margin, operating margin, net income, earnings per share has been really good for ExxonMobil this year, as well as of Chevron. On the other hand, Google, Microsoft, and Meta have been not performing really well. If we go to the 1 year, you will see that this gets even worse for technology companies. We can divide it here into sectors. Yes, if you see, in technology, only Apple has been green. In communication services, which are quite alienated to technology, they are all red. Google and Google with L, that are the ones that are from Alphabet company. Meta being the worst. Also, we can see it in large cap. Snapchat being totally smashed, minus 81%. Spotify 67% down, Netflix 55%, despite the fact that Netflix has improved a little bit, but yes, still not in the top gainers for the last 7 days. Sorry, yes, here it is. You can see here Netflix. Let's analyze just before we go to I'm missing. Sorry, here I forgot the name of the ticker. Yes, sector, communication services. Netflix, yeah, NFL. Yeah, or you can also, I just forgot, but you can also write it down and it's going to appear. Yes, my bad about that. We can see that despite of the fact of having a really good week, from the 8th of November, it has been outperforming, going down exponentially in the last 3 months, minus 55%. Of course, nothing compared to Snapchat. So, well, this is the home. Here you can see also the highest volatility tickers of the day, which ones that have highest IB. You can here have more information in terms of what IB means in these cases. How we calculate IB, of course. We take into consideration the 2 at the money puts and call contracts, monthly contracts, upcoming monthly contracts, and we make an average over that. That's basically how the market take it into consideration. So now if we go to the market scan, let's see if there is any question or questions. Well, what are we going to do is we are going to choose a strategy. Let's say that now that the strategy that we were thinking about is to do a bull put spread. A bull put spread, you can watch here a video. Basically, it gives you a max and a cap win and a cap loss. The cap win is at the credit that you receive at the beginning of entering this contract, and the cap loss basically it's given at the end of the contract, which is the gap between the strikes chosen of the short put and the long put. We are going to create a custom ticker list after we do this one, so you can see that this is 100% personalized. We are going to use mega cap. We are going to use all the tickers, which are 30. We are going to use 100% at the money for the short put and 95% out of the money. And this means basically that we are going to choose strikes that are at the money at the current price of the stock. And for the protection, we are going to leave a 5% gap. Here we have give you some recommendation in terms of aggressive, moderate, or conservative. We are going to base our optimization criteria for this case in return risk. We could use it for strategy yield or probability just profit. The contract that we are going to use is 25 of November. Yeah, 25 of November looks good. We are going to choose any stock price range, and we are going to include stock earnings, stocks that during that period of time will present earnings. After we applied, basically what we are using this tool is to read all the option chains of each one of these 30 assets, 29 assets. We are going to create a ranking that is based on return risk. As you can see it right now, this ranking is based on return risk, and it's going to change every 10 seconds. More or less takes between 10 to 15 seconds. We are going to pause this a little bit so we can make a deeper analysis about what are we seeing, what are we seeing here, how can we read this, how can we basically improve our trading by using this type of tools. First of all, some data that I like to see is the 52-week range. The current IV, this is really important for me. The IV high and the IV for IV percentile 13 weeks and IV percentile IV ranking 13 weeks. Okay. So these for me are basically new columns that I add that for me are really important. What we can see here is that NVIDIA is basically paying us a return risk of 0.6. So for every dollar of risk that we are taking, we are receiving 70 cents, 69 cents approximately. If we are going to analyze this strategy, first of all, the IV is relatively high compared to the peers. But if we take it the IV percentile and IV ranking are quite high. So we are trading now a stock. We will be trading a stock, a technology stock, which currently has an IV which is considerable high. Now let's analyze deeper this strategy. Well, basically what it's telling us is to short a put at 137, buy a long put at 130. The current price is 137. So which basically makes sense. Is telling us, okay, grab at the money is 137, which is the current price, and then buy the protection. For this, we are going to get $3 and the gap is $7. So that's how it's basically calculated return risk. What we can see here is we can see the form or the shape or the shape of the payoff at the end of the contract. And we can also analyze again the volatility that, if you see, is middle high compared to this area, which was low for the last 6 weeks. The company fundamentals, well, we know that it has been not performing well as all the technology sector. And we can now analyze, which was one of the topics, the delta values, how to read them and how they are important. For this strategy, the delta values, what is telling you is that, remember, you are having a positive delta of the short put and a negative delta of the long put. The maximum value of the combination of delta that you can have is 0.557 when it reaches a price of 133. So when you reach 133, which makes totally sense, what's going to happen? This one is going to increase a lot. The gamma of this one is really high because it's at the money and it's going to change into the money. And the gamma of this one, which is, as you can see, is this value, is not as high as this value of gamma. Okay, remember that gamma is not something stable, is something also that changes constantly with time. Sorry, with the underlying price and also with time, but we are not going to analyze that. It changes more with price. With changes of delta. Basically, gamma is the second derivative. So when delta changes, gamma will change. So paying attention into this, when the stock goes up a lot, that is basically what we want. The value of delta, if this, let's say, jump from 137 to 180 or 169, whichever the value is, this is going to go to 0 in the last day. Now, we have to take into consideration that we are not into the last day, that we have period of time, which is the yellow pointed chart is this one. This one is how delta changes every day. And here, what happens, what I'm going to show you is when we do the last day of the yellow one, it should be the same one as the blue one. So if we change this, yes, one goes on top of the other. But returning to the day of today, this is the values of delta that you are going to have with, and I have to be very clear, for today with the changes of price. So delta is very important to take it into consideration. It's very important to take this value, which is going to be the highest value at the end of the contract. Sorry, and to explain and understand that delta is going to move to this shape. Okay, that's very important. So that's one explanation of delta for this strategy. We can see another stock, maybe Microsoft. Microsoft currently trading at 135, so it makes sense that the put sold is going to be 235 and 225. Now let's see what happened when we, well, I open the option of seeing the stock. Now let's try to pay attention what happens when we want to take more risk. Let's take more risk. Let's reduce this to 85% instead of 95%. Okay. What do you think is going to happen with the return risk ratio? Meanwhile, we do this. This is going to take 10 seconds. So what we are increasing is risk. Basically, what's going to happen is we are going to receive more money because we are buying something that is cheaper. But the main thing that is going to happen, the main thing that is going to impact the result of this is basically that we are leaving a bigger gap. So this bigger gap of 15% is going to affect really bad our return risk ratio, which is going to go down quite a lot. Let me refresh here again, because when we change this from 5 minutes to 10 seconds, sometimes this can happen. It may take a little longer to charge the data. There we have it. So the return risk, as we can see, is going to go down quite a lot. But what happens? We still have the strike price of 137, but instead of having of 127, strike of the put bot, we are going to have 117. This give us more money. Remember, we were receiving 2.27 last time, if I'm not wrong, or 2.97. Now we are going to receive $6, but we are taking more risk. We are making more money at consequence of having more risk. Let's analyze one more time. Yes, we are risking 2K. Now, yes, we are risking 2K there. Let me explain this. We are risking 2K here, but we are receiving this amount. So it's $2,000 minus 647. So the max loss is calculated here. The max loss is the difference between the difference between the strike prices, which are $2,000, minus the max return, which is 641, which you will receive at the beginning of the contract, or 647 here. It changed every 10 seconds. So I don't know if that question is answered. Write to me there. We can grab another example. Let's pause this 30 seconds. For the case of Meta, well, here the gap, okay, the gap is 1,400, and we are receiving almost $400. So the max loss must be more or less $1,007. Exactly. This is the value of the max loss. You cannot lose more than this, okay, at the end of the contract. As the same, you cannot gain more than 300. And yeah, thank you very much, Shonsha. Tell me if I am pronouncing correct your name. Thank you. And what we are going to do is we are going to save this strategy. We are going to create portfolio for webinar number 2. We're going to create. You can come here. And we are going to save this strategy. So the good thing is that now when we go to analyze to track portfolios, and here I put webinar 2, we are going to see this strategy that now all the information is being charged, so you can track it every day. You can track your portfolio. You can see how the probability of profit of your portfolio is changing. Let me give you an example. If we can see one strategy here. This one was one that I saved for a client. It was Coinbase. Basically, it was a put sold and a put bought. The break-even point is at 67.45. The current underlying price is 71.55. This strategy pays us $3.15. And now, if we want to buy it back, it's going to cost us $2.93. So we are actually winning, between brackets, unrealized P&L, $22 per contract. I have to clarify that. Yes, exactly. The question that you are asking is totally right, and let's play a little bit with that. Actually, you have recommendation when you choose a strategy that if you want, we can try another strategy. We can try a collar strategy where you buy the stock, a custom naked put, bull call spread. But for the webinar, we decided to use the bull put spread. What we usually here we give recommendation of is something of conservativeness. Okay, we recommend we recommend the short put to be more out of the money. Let's say between 90 and 95. Let's say 93, and the protection. Let's put 87. I think that will be okay. Here we recommend this boundary between 95 to 90 and between 90 to 85. So that's basically what we recommend. before doing this, let's create a costume ticker list so you can see that this is 100% customizable. Let's create webinar 2. So please, if you could start putting, for the participants, if you could put in the chat any ticker that you wish, stock or ETF. So we are going to add it, and we are going to now do any strategy that you think of. Let's, if you want Iron Condor or whatever. So we can make this more customizable for you guys. Okay, QQQ, AMD, OTEX, okay. AMD, QQQ is coming back. What's this one? Yes. Volume, this one is really low. So then if you want, we can analyze that one, but yes, it's not very liquid. It's not a very liquid asset. We have basically the volume, like, so if we compare it to Apple, let's go to one extreme. So yes, that's one extreme to the other one. But yeah, let's just add randomly. So we have JP Morgan, Visa, MasterCard. Let's add Snapchat, Twitter. Now Twitter is going to be extremely stable because basically Elon bought it, so it doesn't make much sense to add it, but yes, let's just add it. Let's save the list. I don't know if there was another SPY. No, we can keep it, but let's add SPY, edit, SPY. Excellent. Save list. So if I am not wrong, we are having 3, 6, 12, 15, 16 tickets. Okay. So we will come here. Let's use long call, or we can still use bull puts. I don't know any strategy. We can go to bearish strategies, neutral with low volatility. Neutral with low volatility, basically, you are selling from both sides. You are selling puts, or basically, if you want to cap your max loss, what you are going to try is not a straddle, it's an iron butterfly, iron condor. Remember that basically the one, you don't choose the same short strikes for the calls and for the put. You leave back up from the at the money. Basically, it's a strategy where you are selling calls and put out of the money and buying calls and put again out of the money, but at a further direction. So basically, it's a combination of, we could see it, a combination of a bull put with a bear put, a bear call. Yeah, bear call. If we can see the shape, it's like this. So if we come back here, bear call and bull put that we were doing. So we can keep with the same bull put, or let's go with something more simpler, short put. Let's choose our use costume ticker list. We will use this one. We are going to use POP. And now we are going here. What appears, I want to explain, this is the contract expiration and the number. If you can see it, I'm going to increase this to 100% so you can see it, you can watch it. You can, the thing that appears basically here are the numbers of the list of stocks and ETF that will have contract for this expiration. In the case of 31 of October, 2 of November, 7 of November, etc., 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 in this case, basically, only Spider, if I am not wrong, and QQQ will have contracts. So I wanted to make that bigger. Let's choose 18 of November. That is the other monthly contract. The M means monthly contract, which are the most liquid contracts. W, weekly contracts, and D makes daily contracts. Okay, let's set filters. All good. Let's go. So now basically in less than 10 seconds, we are going to have a ranking of short puts based on the probability of profit. Probability of profit, you can see here the information is the probability that you will win at least 1 cent. Is taken into consideration the volatility, the break-even price, and the length of the many days or length of the contract. As you can see, it constantly changes. Let's refresh in 5 minutes. We can add columns also. We have a powerful tool that is called Skyblue Trend. This Skyblue Trend basically tells you based on volatility and changes in volatility, which trend has more probability over the next until this contract expiration. In this case, is 20 days. So this is very important to have into consideration when you are deciding a strategy. Okay, which is the Skyblue Trend that we are basing ourselves. Here we have 2 more questions. No, weekly contracts, that's not true. It's not that they are more risky. That's not the reason. They tend to be more illiquid for some tickers, but you can perfectly trade it. You can perfectly trade them. No worries about them. You can trade daily also for Spider and for QQQ. There is no difference between risk in monthly, weekly, or daily contracts. Although I have to say, which is true, you have more liquidity in monthly contract, which that means that basically the spread is between the spread that here we put the spread, the bid-ask is going to be bigger in the case of weekly than in the case of monthly. But again, it's not a very little time because again, we can go in the upcoming months, we can go, I don't know, let's say December, and you will have weekly contracts. You know what I mean? So we can go to the 9th of December. And we can go. I'm going to show you now how we can go to a weekly contract. We can go to a weekly contract that is in December, and it's a weekly contract. Okay, 9th of December. Apply filters. So here you can see short put December 9th, 2022, very near the end of the year, and still you will have the ranking. Like, see, and this pays you like almost a 10%. And again, it's not less time. Basically, weekly contract means that are not the monthly contract. Everything started a couple of years ago when more contracts were into the market and more liquidity went into the market. So at the beginning, there were just monthly contract because of amount of volume that was being traded over the options market. And then they decided to hedge over the weeks instead of over months, which makes totally sense because people might not want to hedge over months or speculate over months. They wanted to do it weekly. And then in the case of QQQ, like if we go to this tool, ticker scan, I'm going to show it to you. We can go to QQQ, apply filter, let's go bearish, November 18. Well, you're going to have here the results, but if you see, you have a lot of daily contracts. You have all these daily contracts that change every 2 days. So basically, in a week, you have 1 weekly contract and 3 daily contracts. Again, in a week for QQQ, Spider, IWM, Spider is SPY. In a week, you will have 1 weekly contract and you will have 3 daily contracts. On average, of course, on average. Here you can see it. See 3, 1 weekly, 3 1 weekly, 1 monthly. If we open December, well, in the case of QQQ, when you go further in time, the daily contracts tend to disappear. But yeah, just giving an example. Now let's move a little. No, but you can perfectly make money over this. Like in QQQ, you could perfectly. Let's do this so we can show it to you. 10 days bullish. Let's be moderate instead of aggressive. Payoff credits. Basically, this ticker scan, what allows you is to analyze all the option strategies in real time for one ticker. So we applied filters. And here you have all the strategies that pays you a credit when you are bullish on the 7th of November. See here the strategy yield that pays you and annualize and how annualized is. Let's now focus on this costume naked bull. This strategy tends to be a little complex. It's not that I always recommend this, but let's analyze. Basically, it's telling you to sell a put that is in the money and then sell a call very out of the money and buy another call just for protection very out of the money. Let's have a further visualization. Sorry, the put is out of the money, not in the money. Sorry about that. I confused there. The price is 281. You are selling a put at 273. You are selling a call at 296. And you are buying a protection at 298. And you can basically make a 10%. You are going to make, if I am not wrong, $295. That's what you are going to make. Of course, you have a max loss, which has a 0% chance that QQQ goes to 0 and you are selling a put. So you would actually lose a lot. But we can go to another strategy that basically the bull put strategy that we were reviewing, or also a bull callback spread. We can also see that one. But let's analyze this bull put. Basically, it's telling you to sell at 275 and buy at 269. Again, you have $6 gap, $600. You receive $159. Max loss $444. You can perfectly make money over this. And again, sometimes, like if you see that volatility is decreasing, it might be a good moment to enter into the market for a short period of time rather than going longer periods. Again, let's go to 5 days instead of 1 week. Let's apply the same filters. You will probably now, if I am not wrong, for the same strategy, let's analyze again the bull put strategy. You are going, just on top of my mind, gain, I don't know, $100 or $110. Probably, yeah, 130 cents. So I was wrong, even more than I thought. 135, and you are leaving $500 of gap, and this is your max loss. And you are taking that risk. The yield that you are having is 0.48 over 277, which is the strike price that you will be executing, which is a pretty good yield, you know, for having just a couple of days. That depends, of course, on the exposure that you have over different assets and you know the type of account that you have with your broker. Just for you to know, very soon we just provide that analytic, but very soon we are going to have we are signing a partnership with TradeStation, so you are going to be able to trade through us. That's very important. So now returning to which was, sorry about this. Let's if we have done all this, if we want to analyze Apple, I wanted to analyze Apple today basically because of the earnings date, despite of the fact that I didn't know that it was going to be a good result, being totally honest. But you know, we decided, okay, yeah, because the market has closed. Yeah, exactly. When you have that sign there are no results for selected filters. It's basically telling you, okay, we cannot find a combination of contracts that have that are interesting for the trader, and that was happening because, well, you know, the market is going to close soon, and I am being moderate. So actually, there were no contracts, as you know, the value of the contracts are going to expire in 18 minutes, and makes no sense to show you those type of contracts because we are talking about pennies. So that's the reason that sign appear, which, you know, it's a really good sign that tells you, okay, you know, there is nothing available in the market right now if you want this strategy, you know, that helps. So for Apple, again, in this case, the custom naked put, it's on top of the table. Usually it's on top of the table because it pays you double credit. It's a combination of the call ratio spread, of the of a short put and a bull call spread. So, you know, it tends to give you basically the spread of these two plus the spread of the short put. We are going also to save the strategy so we can review it for next time. Webinar 2, quantity we can put 100. Save. Let's say. Now let's analyze a little bit which information you are going to say. Well, you are going to say when to expire, the return risk that for custom naked put really doesn't make sense. The max loss that really doesn't make sense for custom naked put. The max return, the strategy IB that, as you saw, it constantly change. The break-even point, this of course is going to be constant and very important. And the probabilities profit is what is going to be changed every 15 minutes. Let's see if the last strategy that we saved, yes, beautiful. Do you remember that we saved this NVIDIA information? Well, let's go into analyze. First of all, you can see the trend here. When many days passes, this of course going to make more sense, and you are going to have the end of date of probability of profit. And here you have the initial probability of profit that was 61%, the expiration, the current probability of profit. So basically, NVIDIA price has been going up or the volatility went down, and the break-even point and the current underlying price. What's going to happen? Well, basically, if this price goes down, the put is going to go to increase of price. So we are going to buy it at a higher price, and we are going to have an unrealized P&L. For the put bot is going to increase of price because the price is going down, but this one is going to increase less than the put sold. Why? Because the put sold has a higher delta. That's the reason. And this is going to turn more negative. I don't know if any of you have a question of what I have just said, but that's basically how it works in terms of the calculation of unrealized P&L. Is the initial credit or debit that you receive, and depending of what happened to the underlying price, how the options are going to move or can move to your side or against you. Perfect. We can also do something in terms of the call, for like we can go here, market scan. So I want to explain the same thing. We can go for the long call or for cover call, that basically is buying a stock and selling a call. Usually the call that you sell it is out of the money or at the money. Again, conservative at the money, moderate out of the money. Let's go 110 out of the money, probability of profit. Yeah, let's go December the 9th. We are going to leave this as settled. Now again, in 10 seconds, we should have the ranking for the 12 stocks, or actually for less than 12 stock because of no, we have for 11 stock, because one stock, do you remember, that wasn't really liquid, so we are going to have always a problem with that stock. If I am not wrong, it was called, just let me check in the chat so we can OTEX. So if we see in the ranking, the only missing one is OTEX. So yes, basically for the call, is we say the strategy. We will have to wait a little bit, but I'm going to we are going to explain exactly the same. So and we are going to do this now with the delta values. So this is the PNL basically. It's cap, and you have the max load that basically is going snapshot to 0. If we analyze delta, what's going to happen with delta? Well, first of all, as you are having a stock, the delta of a stock is always 1. Okay. So when this goes extremely down, you will have the delta of the stock, just the delta of the short call will go down. But what happens if Snapchat goes to $100 or to $15, like says here? Why the delta do you think is going to be 0? Why do you think the delta will be 0? Well, basically because the delta of the short call leg is going to be 1. Sorry, it's going to be -1. So -1 plus 1, 0. What this means? This means basically that your PNL is not going to change. It's this point. See, if we see this point here, $11, and we come here to delta, if you see $11, $12 here, this point, sorry, that is difficult to catch in this case. If you see, we go to 11.75, it's almost 0. So basically this means that when this ends at $11, $11.15, in between there, 11.25, 11.50, this is going to totally unmove your PNL because you have already capped it. And as your PNL is not going to change, why is not going to change your PNL? Because your delta cannot move further. So the short call is going to reach 1, the long call is going to reach 1. If the stock keep increasing, what's going to happen? Okay, you gain $1 from the stock, but you lose $1 from the short call. So if this goes to $100, you're going to gain $100 from the side from the long stock, and you're going to lose $100 from the short call. The value of the short call is going to be $100 plus the current price, that, if I am not wrong, is 63 cents. So it's going to be value 100.63 cents. I hope that basically that makes sense, the explanation with the calls. But it's the same with the puts, but the opposite. Same philosophy, but going to the opposite side. So I don't know. Let's now enter to the QA questions. If you have any questions in regards, please just do it. Please feel free. The platform, I would say that in less than 1 day or in a couple of hours, you can perfectly understand it, because we have, first of all, you can contact us. If you go to contact us, and you can speak with me, and we can make a one-on-one, no problem. But the thing is that if you come here, you go to market scan, you have watch me. This is a walkthrough that will totally explain you each step. If you watch that video for each product, that's going to be extremely clear for you. And we are talking about like 3 minutes, 5 minutes. So in those terms, it's going to be really, really, really easy. I don't use, I have no idea what TOS is. So if you could send me the link, or I could check it here. TOS platform. I believe it might be a platform. Thinkorswim. Are you talking about Thinkorswim? Okay, yeah, I didn't know that. Yeah, sorry. Okay, yeah, that makes sense. No, that platform actually, TOS or Think or Swim. Okay, it's a really, we are going to integrate with a broker. TOS is a broker, it's a platform, but really doesn't offer the tools that, well, actually we have been looking at. But again, TOS is a really great platform. You could perfectly integrate, basically use both of us. We provide that analytics. Soon we are going to let you go into the market with us. But yes, basically our idea is for you to scan the market and to use the ticker scan at the same time, so you can find the optimum recommendation in real time. That's our point of view of what we can provide, and the thing that basically other platforms don't provide. Those again is more a broker than another thing, to say it in some way. It provides you, okay, this type of information, but doesn't compare you 500 tickers, 300 tickers, or the amount of tickers you want. Also, we are much easier, I believe, to understand that Thinkorswim, the front end, or the user interaction, is not my favorite. I prefer TradeStation, to be honest. So if there are no more questions, please, you can contact me. I'm going to leave my email for any questions, anything that you might need. You can contact me, write to us through, if you go here, Skyblue Analytics. I already put my personal email, so you can have that one, or you can, sorry, I have to move this. Here, down here is contact us. If you press contact us, it's going to open to support Skyblue Analytics. So you also have this one. That one, well, you have mine, that is more, we'll reply, I will reply for sure. But if not, you have that one. Well, thank you very much. It's been a pleasure. Anything that you would like to talk about or questions, please tell us. Any feedback also extremely important. But also for next webinar that is going to be in 10 days, in between 10 days and 2 weeks, please, you contact us. And if you want to talk about any topic, we can make it more customizable to your needs. Thank you very much and have a nice day. Well, actually, now we are offering it a 15-day free trial. So you can try it, then it costs $45, so you can have a discount if you pay annually. So for having these tools are new tools that we are going to create, and we are going to show it in the next 2 weeks. So thank you very much. And we keep in contact. Again, you have my email and we can communicate. Bye.